Today, I'm going to reveal how professional traders use this deceptively simple pattern to capture explosive trend moves while everyone else is still trying to figure out what's happening. This isn't some complicated system requiring multiple indicators or advanced degrees in mathematics. It's a straightforward pattern that appears on any chart, in any time frame, and across any market. Have you ever watched a stock explode 50%, 100%, or even 200% higher while you sat on the sidelines, wondering how you missed such an obvious opportunity? What if I told you there's a single candlestick pattern so powerful that it could have alerted you to nearly every major market move of the past decade? Has this ever happened to you? You spot a potential trade setup, hesitate for a day or two, and suddenly that same stock is up 30% without you. That gut-wrenching feeling of a missed opportunity isn't just uncomfortable. It's a sign that your trading approach needs refinement. The truth is, most traders fail because they're looking in all the wrong places. They obsess over small price fluctuations, daily noise, and minor movements that ultimately lead nowhere. But before we begin, please hit the like button and let me know where in the world you're watching from today. It's always fascinating seeing who's joining us from around the world. And if you haven't already, make sure to hit that subscribe button and turn on the notification bell so you don't miss any of our future videos. What I've discovered after years of market analysis is that real wealth isn't built by capturing tiny price jiggles. The life-changing profits come from identifying and riding major trend movements, what I call the big swing. These substantial price shifts carry assets far from their starting points, creating opportunities for transformative gains rather than mere pocket change. Stay with me until the end, because what you're about to discover might surprise you. The most successful traders, throughout history, from Jesse Livermore to Paul Tudor Jones, all share one common trait. They don't waste energy trying to buy the exact bottom or sell the perfect top. Instead, they focus on capturing the middle section of powerful trends, the fat, juicy part where momentum is clearly established and the risk-to-reward ratio is most favorable. Think of a trend like a train leaving the station. At first, it moves slowly, gathering momentum. If you try to jump on too early, you risk slipping under the wheels. Wait too long and you'll miss it entirely. But there's a sweet spot, when the train is moving steadily but hasn't reached full speed, where boarding is both safe and profitable. This is exactly what our candlestick pattern identifies with remarkable precision. The pattern we're discussing today acts like a spotlight, illuminating this perfect entry zone after a trend has started but before the masses have recognized what's happening. It forms when specific market psychology is at play, when smart money is accumulating or distributing positions, creating footprints visible only to those who know exactly what to look for. If you're serious about mastering these powerful candlestick patterns, hit subscribe now. I share real trade setups and market insights that you won't find anywhere else, all designed to help you spot those explosive trend moves before the crowd. These patterns aren't just random formations on your chart. They're revelations of market psychology playing out in real time. But here's where most traders experience their greatest transformation, learning that markets never move in straight lines. Even the strongest trends need to breathe, pulling back before continuing their journey. This natural rhythm creates the hidden truth that separates amateur traders from professionals. When you understand the difference between normal, healthy corrections and actual trend reversals, you unlock a mindset shift that can dramatically impact your trading results. Look at any chart of a stock that's doubled or tripled in value. You'll notice it didn't go straight up. It climbed, pulled back, consolidated, and then continued higher. These pullbacks aren't reasons to panic. They're opportunities in disguise. The bullish engulfing pattern is particularly powerful during these corrections. When a smaller red candle is completely engulfed by a larger green one, it signals the bears attempted to push prices lower, but were overwhelmed by buying pressure. This single pattern often marks the end of a healthy correction and the resumption of the primary trend. Traders who recognize this pattern avoid the devastating mistake of exiting strong positions prematurely, only to watch in frustration as prices continue in the original direction without them. Your journey toward mastering these patterns requires understanding that price movements don't occur randomly. They're the visible manifestation of underlying market conditions and forces, the behind-the-scenes activity that most traders never consider. A candlestick pattern in isolation is just a shape on your screen, but when validated by volume expansion, sector strength, and favorable market breadth, it becomes a high-probability signal worth acting upon. Think about the relationship between cause and effect. Strong trends don't develop by accident. They emerge from fundamental conditions, creating imbalances between buyers and sellers. When institutional money flows into a stock or sector, it leaves footprints visible through specific candle patterns. The pattern you're learning today doesn't just appear randomly. It forms at precise moments when smart money is positioning itself before a significant move. I've witnessed countless traders make decisions based solely on price patterns without considering the broader context. This narrow focus leads to confusion when seemingly identical patterns produce completely different outcomes. The missing piece in their analysis isn't another indicator, it's the context surrounding the pattern. Volume tells you the conviction behind a move. Market breadth reveals the underlying strength of a trend. Sector performance provides confirmation that larger forces support your analysis. Now I want to go even deeper into the patience required to fully capitalize on these patterns, because identifying them is only half the battle. The real challenge comes in how you respond once you've spotted them. This patience element separates those who occasionally profit from those who consistently build wealth through trading. If this explanation of market context and corrections resonates with your own trading experience, write "patterns need context" in the comments below. Patience in trading isn't just a virtue, it's the ultimate competitive advantage. The profound revelation that most traders never grasp is that entering a position is actually the easiest part of trading. The real challenge, the true test of your trading character, begins after you've placed the trade. This is where your inner journey becomes far more important than any technical indicator could ever be. When you identify our key candlestick pattern and enter a position, the market will immediately begin testing your resolve. It might move against you temporarily, creating doubt and triggering that primal fear response that has been hardwired into humans since the dawn of time. This psychological battleground is where fortunes are won or lost, not on chart patterns, but in the quiet decisions you make when facing uncertainty. I've mentored hundreds of traders who could perfectly identify patterns, but still struggled to achieve consistent profitability. The missing element in their transformation wasn't knowledge, it was temperament. They couldn't maintain positions through normal market fluctuations, constantly second-guessing themselves and exiting promising trades prematurely. The hidden truth is that successful traders use candle patterns not just for entries, but as confirmation tools during periods of doubt, reinforcing their original analysis when emotions try to hijack their decision-making. Closely tied to patience is the often overlooked dimension of position sizing. This behind-the-scenes aspect of trading has more impact on your long-term success than almost any other factor. Think about it. If you size positions too large, even minor market fluctuations become emotionally unbearable, forcing you to exit trades that would have ultimately worked out. Your mindset shifts from strategic to survival, making rational decisions impossible. When you spot our powerful candlestick pattern signaling a potential explosive move, the proper approach isn't to go all in with your account. Instead, calculate a position size that allows you to withstand the inevitable fluctuations without emotional distress. This calculated approach creates the psychological space needed to let your winners run without being shaken out by normal market volatility. I remember working with a trader who consistently found himself exiting positions right before major moves. His analysis was sound, his entries were timely, but he couldn't stay in trades long enough to capture meaningful profits. The breakthrough came not from changing his strategy, but from reducing his position sizes by 50%. This single adjustment transformed his relationship with market uncertainty. Suddenly, pullbacks that previously caused panic became merely interesting observations on his journey. Position sizing isn't about how much you can make on a single trade. It's about designing an approach that keeps you in the game long enough to catch those life-changing moves that occasionally present themselves. When you size properly, you create the conditions for patience to flourish naturally, without constant internal struggle. Let's now explore how to develop the pattern recognition skills that make identifying these high-probability setups second nature, allowing you to spot opportunities that remain completely invisible to most traders. If you've ever been shaken out of a good trade because your position was too large, type "sizing matters" in the comments below. Pattern recognition isn't just a skill. It's a complete transformation of how you perceive market movements. When you first begin studying candlestick patterns, they might seem like random shapes on your chart. But through deliberate practice and immersion, a remarkable shift occurs in your perception. What once appeared as chaos gradually reveals itself as an intricate language, a visual representation of the ongoing battle between buyers and sellers. This perceptual evolution is similar to how a doctor learns to read X-rays or how a musician develops perfect pitch. At first, it requires conscious effort and analytical thinking, but eventually it becomes intuitive, an almost instantaneous recognition that bypasses your conscious mind entirely. This is the revelation that separates casual chart watchers from skilled pattern traders who can glance at a chart and immediately identify high-probability opportunities. The engulfing pattern we've been discussing doesn't exist in isolation. It's part of a family of powerful formations, including morning and evening stars, hammers, shooting stars, and harami patterns, each revealing specific aspects of market psychology at critical moments. These patterns become particularly potent when they appear at key support or resistance levels, where historical buying or selling pressure has previously emerged. This confluence of pattern and price level creates the perfect storm for explosive moves. Behind the scenes, what's really happening is a shift in the balance of power between bulls and bears. When a bullish engulfing pattern forms after a downtrend, it signals that sellers have temporarily exhausted themselves and buyers are stepping in with conviction. This power shift often marks the beginning of a new journey upward, one that observant traders can identify and capitalize on before the masses even realize what's happening. The path to mastery requires more than theoretical understanding. It demands immersion in historical examples. By analyzing how specific candle formations preceded major market moves in the past, you build both recognition skills and the confidence essential for decisive action. This retrospective study reveals patterns within patterns, the subtle nuances that distinguish high-probability setups from false signals. I encourage my students to create a personal database of successful historical examples. When you document instances where your target pattern preceded significant moves, you're building a mental library that strengthens your conviction when similar patterns appear in real time. This evidence-based approach transforms vague concepts into concrete trading edge. The mindset shift occurs when you begin seeing current market conditions not as unique events, but as variations on themes you've studied before. This reminds me of Tesla in March 2020, you might think, or this pattern looks just like what Bitcoin did before its breakout last year. These comparative insights don't guarantee identical outcomes, but they provide valuable context for decision-making under uncertainty. What's particularly fascinating is how this historical study impacts your emotional response to setups. When you've witnessed a pattern work successfully, dozens of times in the past, your confidence naturally rises, making it easier to act decisively when opportunity presents itself. The hesitation that plagues most traders dissolves in the face of well-documented evidence. Let's explore how maintaining emotional detachment becomes the critical factor, separating those who occasionally profit from those who consistently succeed in capturing explosive trends. If you've noticed your pattern recognition improving with practice, type "seeing" patterns clearly in the comments below. Emotional detachment might sound counterintuitive in a world that celebrates passion and intensity, but in trading, it represents the ultimate evolution in your journey. The markets are designed to trigger your most primal emotional responses: fear when prices fall, greed when they rise. These emotions served our ancestors well when avoiding predators or gathering food, but they're devastating to your trading account in modern financial markets. The hidden truth that transformed my own trading was realizing that emotions don't just influence our decisions, they completely hijack them. When fear takes over, even the most perfect candlestick pattern becomes invisible, obscured by the fog of anxiety. When greed dominates, we see patterns that don't actually exist, projecting our desires onto random market noise. This emotional interference is the invisible barrier that prevents most traders from achieving consistent results. Ready to transform your trading with these high-probability candlestick patterns? Subscribe now and join thousands of traders who are learning to identify and capitalize on the market's most powerful moves. I remember working with a brilliant analyst who could identify perfect setups during market reviews, but froze completely when real money was on the line. His technical knowledge was impeccable, but his emotional regulation was non-existent. The breakthrough came when he created a decision framework that bypassed his emotional responses entirely. When he spotted our key candlestick pattern, he no longer asked, "How do I feel about this trade?" Instead, he simply executed his predefined strategy, regardless of his emotional state in that moment. This shift from emotional to systematic trading represents one of the most profound mindset transformations possible. It's not about suppressing your emotions, it's about designing a system that functions effectively despite them. Your trading rules become a protective barrier between your rational analysis and your irrational reactions, allowing you to act consistently even under pressure. Behind the scenes of every successful trader is a robust system that incorporates candlestick patterns as key decision-making tools. This system isn't just about entries, it defines your complete approach to the markets, including position sizing, risk parameters, and exit strategies. The system becomes your trading constitution, a set of principles that guide your actions through both calm and turbulent market conditions. The revelation that changed everything for me was understanding that trading isn't about being right, it's about being systematic. When you follow your rules consistently, the mathematics of probability work in your favor over time. A well-designed system with positive expectancy will produce profits when applied consistently, even though individual trades will inevitably result in losses. Consider how this systematic approach impacts your experience of trading. Without clear rules, each decision becomes an emotional battleground, draining your mental energy and clouding your judgment. But with predefined parameters triggered by specific candlestick formations, trading becomes almost meditative, a process of observing, recognizing, and executing without the burden of reinventing your approach with every new opportunity. Your system doesn't need to be complicated to be effective. In fact, the most robust trading approaches tend to be elegantly simple, focusing on a few high-quality patterns rather than trying to capture every possible market movement. This simplicity creates clarity, allowing you to act decisively when your key patterns appear. Let's explore how proper risk management complements your candlestick pattern recognition, creating a foundation of safety that allows you to remain in the market long enough to catch those life-changing explosive moves. If you've noticed how emotions have affected your trading decisions in the past, type "emotions controlled" in the comments below. Risk management isn't just another trading concept, it's the foundation upon which all trading success is built. The profound revelation that changed my entire approach to the markets was realizing that protecting capital is infinitely more important than finding the next great setup. This perspective shift represents a fundamental transformation in how most traders view the markets. While amateurs obsess over entries, professionals prioritize exits and risk control with almost religious dedication. The beauty of candlestick patterns lies in their dual functionality. They serve not just as entry signals, but as powerful guides for stop-loss placement. This hidden dimension of pattern trading creates a natural risk boundary for every position. When a bullish engulfing pattern forms, the low of that formation often represents the exact point where your thesis would be invalidated if breached. Similarly, patterns like shooting stars or dojis appearing at resistance levels provide precise locations for protective stops. This approach to risk management brings clarity to your decision-making journey. Rather than arbitrary percentage-based stops, you're using the market's own language to determine where your analysis would be proven wrong. This alignment with actual market structure typically results in more efficient risk parameters, tight enough to preserve capital, but loose enough to withstand normal market noise. Behind the scenes of every spectacular market move are early warning signals, subtle candlestick formations that most traders completely overlook. These early patterns represent the initial stages of accumulation or distribution, where smart money begins positioning before the trend becomes obvious to everyone else. Learning to recognize these early signs is like developing a sixth sense for market direction. You begin to feel the shift before it manifests in obvious price movement. Consider the humble hammer candlestick, a pattern showing rejection of lower prices with a small body and long lower shadow. When this appears after a downtrend, particularly with expanded volume, it often signals exhaustion among sellers and the potential beginning of a new uptrend. Similarly, shooting stars appearing after an uptrend can indicate that buyers are losing momentum and a reversal might be imminent. What makes these early patterns so powerful is their risk-reward profile. By identifying potential trend changes early, you can establish positions with minimal risk while capturing the majority of the subsequent move. This positioning advantage is the ultimate edge in trading, getting in before the crowd with clearly defined risk parameters. Volume analysis provides essential context for these early patterns. When a hammer formation coincides with a significant increase in volume, it suggests genuine buying interest rather than random price action. This confluence of pattern and volume creates a much higher probability signal than either factor alone. It's the market equivalent of multiple witnesses confirming the same story. Each additional piece of evidence strengthens your conviction. The mindset required to spot these early formations differs dramatically from conventional trading psychology. While most traders wait for obvious, unmistakable signals, the pattern hunter develops sensitivity to subtle shifts in market behavior. This perceptual refinement allows you to see the early stages of accumulation or distribution, the footprints of institutional activity before the trend becomes obvious to the masses. Let's explore the crucial skill of waiting patiently after identifying these patterns, allowing trends sufficient time to develop without premature interference. If you've ever spotted an early reversal pattern before a major market move, type "early pattern spotted" in the comments below. Waiting might sound passive, but in trading it represents the most active form of discipline you can develop. The profound paradox that transformed my trading journey was realizing that the hardest work in this profession isn't finding patterns or executing trades. It's sitting completely still once you're in a promising position. This counterintuitive mindset shift challenges everything our action-oriented culture celebrates, revealing the hidden truth that sometimes the most powerful move is no move at all. Think about how this principle applies to our candlestick patterns. You've identified a perfect bullish engulfing pattern, confirmed it with volume and market context, entered your position with appropriate size, and placed your protective stop. Now comes the real test. Can you allow the emerging trend sufficient space and time to develop? Most traders fail at precisely this point, unable to resist the urge to micromanage their positions. Behind the scenes of every spectacular market win is a trader who mastered this art of waiting. They understood that trends unfold according to their own natural rhythm, not according to our impatient desires. The market doesn't care about your timeline or your profit targets. It moves when and how it wants to move. Your only job after entering is to give it the freedom to work in your favor. This waiting period creates an internal battlefield where your emotions wage war against your rational analysis. Every price fluctuation triggers doubt. Every news headline raises questions. Every opinion from others creates confusion. Yet the disciplined trader sits calmly amid this chaos, trusting their original analysis and giving the market time to prove them right or wrong. Closely connected to this waiting skill is perhaps the most critical revelation in trading psychology, learning to let your profits run. This transformation in approach completely redefines your relationship with winning trades. The tragic reality I've witnessed repeatedly is traders capturing only a fraction of potential gains by exiting profitable positions far too early. They celebrate taking a quick 10% profit while missing the 100% move that was developing right before their eyes. When powerful candlestick patterns signal the beginning of a major trend, your mindset should shift from "when should I take profit" to "how can I stay with this move as long as possible?" This perspective change creates the conditions for truly life-changing trades. Instead of focusing on exits, focus on trailing your stops to protect accumulated gains while allowing further upside potential. These trailing stops can be based on subsequent candlestick formations as the trend develops. For example, when a strong uptrend produces a bearish engulfing pattern after an extended move, it often signals potential exhaustion, a natural place to tighten stops or consider partial profit-taking. The beauty of this approach is that it lets the market itself tell you when it's time to exit, rather than arbitrary price targets that have no relationship to actual market structure. The journey from good trader to great trader often hinges on this single capability, the ability to capture the full potential of your best ideas. Many traders can identify patterns and enter properly, but few develop the emotional resilience to ride trends to their natural conclusion. This patience creates the asymmetric returns that transform ordinary accounts into extraordinary ones. Let's explore the critical distinction between the gambling mindset that plagues most traders and the operator's approach that creates consistent, long-term success. If you've ever exited a winning trade too early, only to watch it continue moving in your favor, Type "letting winners run" in the comments below. The distinction between gamblers and operators reveals one of the most profound mindset transformations in trading psychology. This revelation completely reframed my understanding of what successful trading actually looks like. While most aspiring traders envision a life of constant action, buying and selling throughout the day, always engaged with the market, true professionals often spend most of their time simply observing, waiting for the perfect setup to present itself. Gamblers crave action. They need to be in a position, any position, to feel they're participating. This addiction to activity leads them to chase low-probability setups, force trades when nothing compelling exists, and ultimately lose their capital through 1,000 small cuts. Behind the scenes, what's really driving this behavior isn't strategy, but psychology. The gambler trades to satisfy emotional needs rather than to generate consistent profits. Operators, by contrast, approach the market with calm detachment. They understand that quality trumps quantity in every aspect of trading. They'd rather take 3 high-conviction trades a month based on powerful candlestick patterns than 30 mediocre setups with unclear edge. This patient, selective approach feels counterintuitive at first, like you're not doing enough, but it represents the journey from amateur to professional thinking. I remember working with a trader who measured his success by how many trades he completed each day. His identity was tied to being busy in the market. The breakthrough came when he began tracking his results by setup type rather than frequency. The revelation was immediate and jarring. Over 80% of his profits came from just 2 specific candlestick patterns, while the majority of his other trades produced either small gains or losses that offset each other. This insight transformed his entire approach. Instead of trying to trade everything, he focused exclusively on his 2 most profitable patterns. His trading frequency dropped dramatically, yet his profitability soared. He had completed the transition from gambler to operator, understanding that patiently waiting for ideal setups was his true edge. Your own evolution as a trader must include this fundamental shift: learning to value quality over quantity, patience over action, and conviction over diversification. When you spot that perfect engulfing pattern with all the right contextual factors, you should be willing to commit meaningful capital with complete conviction, rather than taking small positions across numerous questionable setups. Ultimately, the market itself becomes your greatest teacher on this journey. No book, course, or mentor can provide the experiential wisdom that comes from personally witnessing how candlestick patterns perform across different market conditions. This hands-on learning builds an intuitive understanding that transcends intellectual knowledge. You begin to feel the market's rhythm rather than just analyzing it. The most valuable patterns in your trading arsenal will be those you've personally verified through experience. When you've witnessed a specific formation lead to profitable outcomes repeatedly, it creates a level of conviction that can't be shaken by temporary setbacks or others' opinions. This experiential validation transforms theoretical concepts into practical tools you can rely on when real money is at stake. Let's explore how these candle patterns can be used not only for entry signals, but as powerful guides throughout the entire life cycle of a trade, from initial positioning to final exit. If you're committed to developing the mindset of an operator rather than a gambler, type operator a mindset in the comments below. As we've explored the profound impact these candlestick patterns can have on your trading results, I hope you're beginning to see trading less as a series of transactions and more as a journey of self-mastery. The patterns we've discussed today aren't just shapes on a chart. They're windows into market psychology that can transform your entire approach to the markets. If you've found value in these insights and want to continue developing your pattern recognition skills, consider becoming part of our trading community by hitting the subscribe button. Each week, I share these exact patterns and setups as they form in real time, helping you build that invaluable market experience we discussed. The journey we've started today is just the beginning. If you've made it this far and are committed to mastering these patterns, type Pattern Mastery Unlocked in the comments below. I personally read every comment and love connecting with serious traders who are on this path of continuous improvement. If this conversation resonated with you, a simple like lets me know these deeper trading concepts are hitting the mark. It's not about popularity, it's about creating content that genuinely helps you capture those explosive trend moves we all search for. For those ready to take the next step, I've created a video right here that shows these exact patterns playing out in 3 recent market examples, complete with entries, stops, and how to manage the trades for maximum profit. Click and join me there as we move from theory to practical application, seeing these principles come alive in actual market conditions.